Welcome to the Deep Dive. Our mission is simple. We take a stack of your sources, the articles, the research, the market notes, and we turn them into focused, actionable knowledge.
And today, we're diving into a flurry of events, all centered on one really pivotal day in global finance.
Wednesday, December 10th, 2025. This was the day that, well, it seemed to give us everything we wanted, but it also kind of hid the catch.
It was a truly conflicted moment. I mean, the material we looked at showed four competing stories all playing out at once.
Okay, so what were they?
Well, you had major central bank policy shifts, especially from the U.S. Fed. Then you had these just massive corporate earnings from a tech giant like Oracle.
Right.
On top of that, an accelerating M&A trend in the financial sector, and maybe the most surprising thing, a pretty convincing rebound in commercial real estate, at least in some pockets.
So the central paradox for you, the listener, and really for the market itself, is this macro pivot from the Federal Reserve. Everyone expected a rate cut, but the real drama is in the conflicting signals.
Exactly. They eased today by delivering liquidity, but almost in the same breath, signaled a halt to easing for 2026.
And we need to unpack that tension. We need to figure out what it means for everything from tech valuations to, well, the long-term prospects of the global economy.
All right, so let's start with the immediate policy action. The Federal Open Market Committee, the FOMC, it delivered what was, largely anticipated.
The third consecutive 25 basis point rate cut.
Right. That sets the Fed funds rate target range at 3.50% to 3.75%.
But even though the cut itself was priced in, the internal debate, that really shows the tension inside the Fed about what to prioritize right now, growth or inflation.
The vote was split 9-3.
And that 9.3 split is crucial, isn't it? It tells you this debate is far from over.
It really is. You had a faction pushing for a deeper 50 basis point cut, which suggests they see recession risks rising fast.
They wanted immediate, decisive action.
But then you had two other members who wanted to keep rates exactly where they were, signaling they're still worried about core inflation. Maybe they think the job market's still too tight.
That dynamic is the whole story. They cut rates, and the reason they gave was a shift in the balance of risks and a need to stabilize the labor market.
The employment half of their dual mandate.
Right. But that reasoning feels a little thin when you actually look at their own projections.
It does. The Fed's own staff projects unemployment will only edge up to 4.5% by the end of 2025. That is not a severe recessionary threat.
So if the unemployment picture isn't dire, their reason for cutting now seems to be based on what perceived future risks.
That's a big part of it. But the policy action wasn't just the cut. This is where the Fed got really tactical.
Okay.
The rate cut was coupled with a non-standard move. The announcement of a pretty substantial $40 billion monthly Treasury bill purchase program.
And that's the crucial part, the liquidity twist, as you called it.
Exactly, a tactical liquidity injection.
So explain that for us quickly. What is the liquidity twist and why now?
It's basically a short-term cash injection into the banking system. By buying short-term T-bills, they're adding cash reserves to the system without, technically changing the long-term rate structure.
And the timing.
They did it to ease any immediate funding constraints to make sure the market keeps functioning smoothly. It provides that immediate positive sentiment, which is often what the market needs most.
So the market gets a rate cut and gets the immediate cash. And that caused the short end of the curve to slide pretty sharply. The 2-year yield dropped 7 basis points.
Instant euphoria, stocks go up. But then comes the other shoe.
The structural conflict. They immediately pump the brakes on what's coming next.
That is the core insight of this whole deep dive. The updated Fed dot plot, which is just the FOMC members' anonymous guesses for where rates will be, it suggests only one more rate cut.
For the entire year of 2026.
For all of 2026. Just one.
Wow. That is way more conservative than I think a lot of investors are expecting. So they give with one hand today, but signal a complete halt to easing next year. Why? What's behind that hawkish guidance?
It's all anchored by the underlying economic strength they still see, despite the current risks. The Fed is counting on, and I'm quoting here, significantly increased economic growth projections.
And they have some data to back that up, right? I'm
Yeah.
seeing it in the sources. Initial jobless claims.
They plummeted, down 27,000 to 191,000 for the week ending November 29th.
And that's the lowest level since September of 2022.
Exactly. That data suggests the pace of layoffs is slowing way down, which gives them the evidence they need to say the economy is robust enough to handle these rates.
So the Fed is basically saying, look, we fixed the immediate liquidity issue.
But don't expect a long easing cycle because we think real growth is coming back faster than you think.
But wait, hang on. Isn't relying on one single week's drop in jobless claims a little risky?
Yeah.
I mean, that feels like a fragile foundation for such a strong commitment to keeping rates high next year.
It absolutely is a risk. The danger is that they're betting on an overly optimistic growth story for 2026. If that growth doesn't show up, they risk having to do an emergency correction later.
And that's the structural risk you need to be watching.
For sure. And you can see how this is really a U.S.-centric story right now when you look globally.
Right, the European Central Bank. In sharp contrast, they maintain their key interest rates, keeping that deposit facility rate at 2.00%.
Yeah, they're focused on a much more modest growth projection for the euro area, about 1.2% in 2025. It just highlights how different the situations are. The U.S. is doing this tactical easing while the ECB is still very much anchored in fighting inflation.
Okay, so let's move from that macro confusion to the high-flying tech sector, because Oracle's Q2 fiscal 2026 results also dropped on December 10th, and they were just phenomenal.
The headline numbers alone were impressive. Total quarterly revenues up 14% to $16.1 billion. GAAP earnings per share surged 91% to $2.10.
But those numbers, as good as they are just the appetizer.
They really are. The main course, the number that just validated this whole enterprise AI spending boom, is a metric called remaining performance obligations, RPO.
Ah, the $523 billion shock. We should probably sit with that RPO number for a second.
We definitely should. Total RPO, which is just contracted future revenue money that clients have already signed contracts to pay Oracle, it surged an unbelievable 438% year over year.
Hold on. 438%.
438%. It brought the total to $523 billion.
Wow. A surge like that, it just fundamentally changes the AI investment thesis, doesn't it? This isn't about small pilot programs anymore.
No, it's structural. This growth is being fueled by huge new commitments from massive clients like Meta and NVIDIA. It confirms that companies are funneling billions into cloud and AI because they see it as an operating mandate, not a novelty.
They're afraid of being left behind.
And they're signing $500 billion in future contracts to make sure they aren't.
So the implication for you, the listener, is that enterprise spending on AI has moved from the experimental budget line to the essential operating budget line. That is a permanent shift.
And that massive shift in demand is what drove Oracle's big strategic pivot announced that same day. Chairman Larry Ellison confirmed they'd sold their interest in the Ampere chip company.
Which sounds counterintuitive, right? When demand for AI hardware is so hot, why sell a chip interest?
Because they're pivoting to what they call chip neutrality. Oracle's leadership realized that making their own custom chips was actually a liability. They need agility.
So by being chip neutral, they could just deploy whatever chips their customers want to buy.
Instantly. Whether it's the latest NVIDIA GPUs or something else, they aren't stuck on their own development timeline.
It's about being the infrastructure provider, not the hardware designer. And that's paying off right away in their database business.
Absolutely. They're a multi-cloud database business, which lets you run Oracle databases on any cloud, Amazon, Google, Microsoft. It's their fastest growing segment, up an astronomical 817% in Q2.
That's the flexibility enterprises are demanding. Powerful data management, no vendor lock-in.
And this momentum wasn't just Oracle. The whole tech sector was visibly resilient that day. It almost ignored the mixed signals from the Fed.
Right. The S&P 500 information technology sector was the only sector in the green that day.
We also saw more consolidation around this theme of data for AI. IBM acquired the AI data software company Confluent CFLT for $11 billion.
And that sent Confluent shares up, what, nearly 30%?
Almost 30%. It just underscores the premium being placed on tools that manage and prepare data for these AI models. That market is red hot.
Okay, let's shift now to the financial world. It seems like it's seeing this accelerated need for scale, driven by tech costs, but also by a big shift in the regulatory mood.
Yeah, banking M&A momentum is really picking up. Our sources show that through Q3 of 2025, over 125 deals were announced, worth more than $24.2 billion.
And that already exceeds the prior year's total by a lot.
It does. And the catalyst isn't just cost-cutting, it's a change in the political winds. Regulators are signaling clearer criteria, shorter queues for deals that aren't controversial.
They're easing the intense scrutiny that had choked off big bank mergers before.
And that speed is a game changer. It just improves the deal math for everyone. I mean, when approval times shorten, buyers can pull forward all those cost savings much faster.
We saw that with Atlantic Union Bank shares, right? They got approval in just 7 weeks.
Exactly. That kind of speed and certainty encourages more buyers to come to the table.
And that consolidation is rampant in wealth management, too. The hunger for assets under management, AUM, it's just continuous.
The volume of deals is staggering, and it shows the pressure on those mid-size advisory shops. We're seeing this intense hunger for AUM driving firms to buy up anyone managing between, say, 500 million and $1 billion.
So scale is now basically mandatory to compete.
To afford the technology and compliance, yes.
Now, for the segment that surprised a lot of people, commercial real estate. This sector's been in a deep freeze for years because of financing uncertainty. But Q3 2025 signaled, a potential thaw.
It did, but we have to be clear, this is a very selective recovery. Institutional capital is coming back now that there's more clarity on financing costs.
Okay.
Large single asset deals, so over $10 million, totaled $76.4 billion in Q3. That's the strongest growth rate in a decade.
So investors are finally confident enough to underwrite these long-term assets again. Which property types are seeing the benefit?
The pricing is firming up for industrial, retail, and multifamily assets. Those sectors have strong structural demand, logistics, consumer spending, and housing shortages.
But that differentiation is key because one sector remains a clear laggard.
That would be office space.
Right.
Office is the outlier. The median transaction size for office properties has fallen almost 24% from its peak back in 2013. It's a decade-long slide. The capital's just flowing away from legacy office towers.
A very bifurcated recovery. Okay, so as we transition out of the U.S. focus, let's widen the lens. While U.S. markets are cheering tech contracts and CRE, Europe is having a very different conversation.
That's the critical link. We mentioned the ECB held rates, and that connects to this very sobering view from ECB President Christine Lagarde about Europe's economic structure.
She warned that Europe's traditional export-led growth model is straining, and crucially, that its internal market, the foundation of the EU, is stagnating.
She presented some incredibly challenging data. Despite decades of work on the single market, their analysis shows internal trade barriers are still immense. For services, they're equivalent to tariffs of around 100%.
100%, wow.
And for goods, it's about 65%. That internal friction is just preventing European economies from reaching their potential scale.
So the biggest constraint on European growth isn't an external trade war. It's the lack of integration within its own borders.
Precisely. And that's why you see so much European savings and investment capital flowing into more dynamic markets like the U.S. instead of fueling growth at home.
Her message was that Europe needs real structural reform to move from just being resilient to becoming genuinely strong.
It was a stark warning.
So to review the threads we pulled from December 10th, we saw a market high on Oracle's AI contracts and immediate Fed liquidity.
But structurally confused by a central bank that's handing out cash with one hand while clutching the brakes for 2026 with the other.
At the same time, we're seeing M&A speed up, driven by regulatory certainty in tech and a very selective recovery in commercial real estate.
It was a day of intense action, heavily skewed toward U.S. tech growth and tactical policy moves. The U.S. market is still relying on corporate innovation and Fed intervention to keep things going.
Which brings us to a final provocative thought for you to mull. If the U.S. market continues to rally on high-tech RPO and tactical Fed liquidity, while Europe is grappling with these deep internal trade barriers that stifle capital flow, how critical is the debate over structural governance reform?
You mean like changing how the EU makes decisions on complex things like company law and taxation?
Exactly. Is that kind of structural change necessary to ensure that Europe can move from being merely resilient to becoming genuinely strong in the years ahead? Or is corporate innovation the true catalyst for future growth?